The Nikkei just ripped higher by over 2%, adding 1,400 points in a single session. Everything looks unstoppable. The monthly trend is a strong buy. The weekly trend is a strong buy. The daily, the 5-hour, the 1-hour, every time frame screaming long. And that is exactly why most traders are about to walk directly into a liquidity trap that the smart money has already set. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end because I'm giving you 3 exact levels you can trade tomorrow, with precise entries, exact stops, and risk-reward ratios that actually make sense when the volatility spike comes. Write this number down immediately. 63,666. That is the line in the sand. If the Nikkei breaks and closes below 63,666 on a daily time frame, the entire bullish structure resets. That level is your invalidation for every long idea I'm about to share. Right now, price sits at 65,416. We are almost 2,000 points above that floor, and the entire market is convinced that the only direction is up. The instant market verdict is this: we are in a powerful trending environment. The average directional index on the daily is above 42, but we are fading into overbought exhaustion on short-term oscillators. The bias is a trend continuation with a pullback first. In plain terms, this is a buy-the-dip market until 63,666 breaks. I am not chasing this move at 65,400. I am waiting for the retest. The herd is positioned almost entirely one-way long. Institutional flow data shows record net long positioning in Nikkei futures among leveraged funds. When everyone is on the same side of the boat tips. That's not a guess, that's market structure. The single level that flips my bias from buy the dip to sell the rip is a daily close below 63,666. Until then, every sell-off is an opportunity, not a panic. Let me walk you down from the highest time frame because that's where the real architecture lives. The 200-week moving average sits at 54,588, and we haven't been anywhere near it in months. The price is trading so far above the 200-week that the deviation is extreme, and yet the slope is still accelerating upward. That tells you this is not some fragile bounce. This is an institutional-grade trend with deep structural support. Come down to the daily chart, and the moving averages are stacked in perfect bullish formation. The MA50 at 62,268 is pointing higher. The MA100 at 59,055 is curling up aggressively. The MA200 at 54,588 is the floor of the long-term trend. But what matters most right now is the MA20 at 64,839. That 20-day moving averages acted like a magnet all month, and price is currently about 600 points above it. Every time the Nikkei has stretched this far above the 20 MA, it has either consolidated sideways for several days or staged a sharp one-day mean reversion flush to reset the momentum. That is not a bearish call. That is the rhythm of this trend. The pivot point for today is 64,890, almost identical to the 20 MA. That confluence is your anchor. Now drop to the 4-hour chart, and here's where it gets interesting. The MACD on the 4-hour has just started to roll over. The signal line is still above zero, but the histogram bars are shrinking, a textbook negative divergence against the latest leg higher. In plain language, buyers are exhausted even though price hasn't turned yet. The stochastics on the daily are sitting at 95, deep in overbought territory. Williams percent R is at -5. This does not mean sell blindly. It means the probability of a shakeout before the next leg higher is extremely high. The hidden divergence most traders miss is not on the price chart. It's between the price and the yen. The Nikkei has been moving tick for tick with dollar-yen. Every pip higher in USD JPY pumps the Nikkei because a weaker yen inflates exporter earnings. But dollar-yen is now approaching the 160 zone where the BOJ has historically intervened verbally, if not physically. That cross-asset linkage is the real invisible thread. If dollar-yen stalls or corrects even 2 big figures, the Nikkei will gap down inside a single session. That's the trap. Most traders see a green candle and hit buy, They do not see the yen tightening around the neck of this rally. Here's the level that separates winners from losers on this chart. On the upside, the immediate resistance is 66,374. That is R1, and a clean break above it with a 4-hour close opens the door straight to 67,599, which is a 2, and then to the macro target at 69,083. On the downside, the first serious support beyond the 20 MA is 63,666, your S1, followed by 62,182. Below that sits the base at 60,957. Every single one of these numbers matters. The average true range is 1,556 points. That means the daily range is swallowing these levels regularly. You cannot trade this index with tight stops and hope to survive. You have to position size for the volatility. Let's connect the last 24 hours of news to this price action. Overnight, Japan stocks closed higher by 1.92%. The Nikkei specifically added 1,400 points in a single session. The catalyst wasn't a new BOJ announcement, it was the absence of one. The market has fully priced in that the Bank of Japan will not rock the boat. That yield curve control will remain ultra-accommodative, and that the yen will continue to be used as the world's funding currency for the carry trade. That narrative is now consensus. And consensus narratives eventually break, usually when the last buyer has bought. The 2-week directional lean remains bullish as long as 63,666 holds. The event that would invalidate this entirely is not just a BOJ rate hike, it's the hint of one. A single summary of opinions mentioning yen weakness as a concern would trigger a multi-thousand point unwind. Do you think the Nikkei breaks 69,000 this month? Comment yes or no right now. I'm tracking consensus against the actual flow data. Most people skip this next section. That's exactly where the money is made. Keep watching. I'm about to give you 3 concrete trade plans, each with an on-screen graphic you can screenshot, exact entries, exact stops, and exact risk-reward. Use them, adapt them, but don't trade without a plan. Strategy 1, the sniper. This is the conservative play. We wait for the pullback that almost always comes when the daily stochastics are this overbought. Your entry trigger is a pullback to the 64,850 zone. That is the 20-day moving average and the pivot point confluence. You do not buy blindly there. You wait for a 4-hour bullish engulfing candle closing above 64,900. That confirms the dip buyers have stepped in. Your stop loss goes at 64,400, just below the intraday liquidity low that will form if this pullback gets deeper, and safely below the 20 MA with a buffer. Take profit 1 sits at 66,374, which is the R1 resistance. That's a risk of 450 points against a reward of 1,524 points, a risk-reward ratio of 1 to 3.4. Take profit 2 is at 67,599, giving you a 1 to 6.1 ratio. This setup is void if the daily candle closes below 63,666. That's the invalidation. Respect it. The sniper, conservative, entry, 64,850, for H bullish engulfing close above 64,900, stop loss, 64,400 take profit 1, 66,374 take profit 2, 67,599 risk, reward. 1 minute and 3.4 seconds 1:6.1 invalidation. Void if daily close below 63,666. Strategy 2, the active trader. This is for those who want to capture the breakout momentum but with a structured plan, not a chase. Entry condition, a 1-hour candle close above 66,374. That confirms acceptance above the resistance zone. Your entry is market at 66,400. Stop loss goes below the breakout level at 65,800, which is a logical area that would indicate the breakout was a false move. Take profit 1 is 67,599. Take profit 2 is the macro target at 69,083. That's a 600-point risk for a reward of 1,199 points on TP1, ratio 1 to 2. Once TP1 is hit, trail your stop to break even and let the runner ride. If the 1 hour candle closes back below 66,000, the setup is compromised. Reduce exposure. Type your Nikkei range for tomorrow in the comments now. I want to see who's aligned with the 64,800 to 66,400 band. The active trader, standard, entry, 66,400, 1H close above 66,374, stop loss, 65,800 take profit 1, 67,599 take profit 2, 69,083 risk, reward, 1 minute and 2 seconds, 1:4.5 invalidation, 1H close back below 66,000, cancel runner strategy 3, the aggressor. High risk, high reward, counter trend. This is for traders who understand that overbought extremes in a strong trend can produce violent mean reversion moves. Your entry is a short near 66,000, but not just at any 66,000. You need a 15-minute bearish divergence with a shooting star or a failed breakout wick. Entry specifically at 65,980, just below the psychological level. Stop loss is tight at 66,400, above the R1 and a fresh swing high. Target 1 is the 20 MA and pivot confluence at 64,890. Target 2 is S1 at 63,666. Risk is 420 points. Reward to TP1 is 1,090 points. Ratio 1 to 2.6. This is not a hold and hope trade. If price rips through 66,374 and closes above on the 1 hour, you are wrong, get out. Only take this if you can lose small and manage risk aggressively. Do not martingale. Do not add to losers. The aggressor, high risk, entry, 65,980, 15M bearish divergence plus rejection wick, stop loss, 66,400 take profit 1, 64,890 take profit 2, 63,666 risk, in reward, 1 minute and 2.6 seconds 1:5.5 invalidation, 1H close above 66,374, exit immediately. Risk management pulse. Never risk more than 1 to 2% of your account on any single trade. No new positions through high-impact economic releases, especially anything from the BOJ or the US session data that moves yen pairs. Stops are non-negotiable. This is how you survive to trade the next big move. Let me close with the single most critical level for the next session. It is 64,839, the 20-day moving average. If price pulls back and holds above that level, this is a textbook trend continuation by zone. If it slices through and closes below on the 4-hour, the overbought unwind becomes something uglier, and we will likely see 63,666 tagged within 48 hours. Tomorrow's wildcard is the Tokyo Open reaction to any overnight yen move. If dollar yen gaps lower, expect the Nikkei to open on the back foot and test the MA20 immediately. That pullback is the opportunity I'll be waiting for. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Tap the end screen. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one.